Right, good afternoon, everybody. Welcome to today's session. This is Adrian Boothie speaking. I'm the head of trading here at Trend Signal, and today we're going to be talking about how to trade the 4-hour charts. What are we, the 27th of September? It's lunchtime. There's quite a bit going on at the moment. As you'll know, we'll talk a little bit about that as well, I'm quite sure. But today it's going to be mostly looking at foreign exchange. We've been looking at trading the 4-hour chart as a specific time frame. We're going to spend some time looking at sort of ways in which we might recommend to do it, and a bit more as well. So just a little bit of housekeeping as we get started. Depending on the type of device you're on or how you're watching us today, this could be a little bit different really. But if you're using GoToWebinar to access this webinar, then if you're on a tablet, smartphone, it's going to look a little bit something like this. Can you just type something in for me? Just type hello, just so I know it's all coming through loud and clear. So I know a lot of people are watching this on GoToWebinar, but also we are streaming out on YouTube, Facebook, LinkedIn, and Twitter as well, I think. So it might be a bit trickier to interact there, or certainly for me to monitor all of these different chat channels, but you can certainly go through there. As far as the sort of downloaded version, it depends on the type of device you're on. There's a few different GoToWebinar applications, but maybe you need to click this orange button and type in. It should be fairly self-explanatory anyway, but just type something in for me if you don't mind. Just type hello, yes, or something like that. Okay, so Malcolm, so you've been trading some different time frames, never traded the 4-hour charts. What is the reasonable time or times to look and check? I know you cannot be specific. I can be very specific actually, and we're going to be today, Malcolm. So thank you for the question, and well, let's get on with it, shall we? So um, like I said, we're talking about the 4-hour chart today. Before we get into it, a little bit of a risk notice, I'm afraid. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. Now, obviously, today we're really talking about education, but of course, the way in which you apply that education in the real world is usually by trading spread bets and CFDs. Okay, so let's get on with that. The first thing I want to focus on today is time frames. So Malcolm actually made reference to trading 2-minute charts, trading daily charts, trading 4-hour charts. These are three of the key time frames that I think probably the most effective time frames for individuals to follow, largely because they suit most people's day-to-day lifestyles. Okay, so the way in which you could have a great strategy, but if you're not following it properly, it doesn't really matter how good that strategy is. You're never going to get the results as per that strategy. So you could be you outperform it, it could be you underperform it. Who knows? It's probably going to be a little bit random. So the thing with it is that the more a strategy suits your lifestyle, the more you're going to follow that strategy effectively. And therefore, it is important, if you have a good strategy, that is, that you trade in a time frame or a way that works around your day-to-day commitments. Because if you don't, it can be quite a frustrating experience. Actually, you most likely you're going to underperform your strategy, and that's because you're going to be doing all sorts of weird and wonderful things. And what might those include? Well, if you're on the wrong time frame, you're probably going to miss lots of trades because they're setting up whilst you're not at your screen. So if your time frame requires you to trade for 6 or 7 hours a day, because that's just the way it is, but you can't trade for 6 or 7 hours a day because, well, let's face it, most people can't, don't have the time, don't have the inclination to do so. You're going to miss lots of trades. You're going to turn the computer on and go, oh God, look at all that I've just missed there from 3 hours ago. That's really annoying. And it usually means you just get a bit frustrated. The psychology can often be against you. You're often missing the best sessions. And actually, you're probably not getting a good full sample of the opportunities for the strategy. So what that means is, let's say that your strategy required you to trade for maybe 8 hours a day, but you can only trade for 2 hours a day, then of course you could get lucky and get the best trades of the 8 hours in your 2-hour time block, but you're probably not going to be, and it can be a little bit frustrating, and because of that your results can be wildly different. What you're also going to do is you're going to find that there's nothing setting up, but I'm here anyway, so I might as well play some trades. And it can be a case where if you're on the wrong time frame, you end up breaking your rules and breaking your trading plan. You should have a trading plan, just like any business should have a business plan. Just a set of rules, a set of parameters that you should be going through, processes you should be going through for your trades. You'll find that if you're on the wrong time frame, you'll end up breaking that, which probably means you'll end up more gambling, which probably means you'll be making bad trading decisions. So that's not a good thing. So time frame again, very, very important. The other thing, entering trades late or early, is very important as well. So, there's sort of, I'm not talking about entering sort of 5 minutes early on a daily chart or something like that. What I'm talking about is what'll often happen is that if you're on the wrong time frame, people will end up saying, well, I'm supposed to be trading at, I don't know, 2 o'clock this afternoon, but I'm not going to be there then. It's 12 now, so why don't I just put it on now? The problem is you end up entering a trade that may not be a fully established trade come 2 o'clock. It depends on the type of strategy you're running and how your trades are identified. But entering a trade early can often mean you're entering a trade based on something that is looking like it's going to happen, but may not happen. So, for example, if indicators are still being created, still being plotted because the candlestick is still being plotted, then it's not going to be a trade until maybe 2 o'clock if it's a 4 hour chart, or maybe 10 p.m. if it's a daily chart. The point is, you want to be trading around that close as much really as possible. So, for example, if you're trading on a daily chart, it's good to trade more towards that 10 p.m. kind of time, sort of 8:30, 9 o'clock, 9:30, that sort of thing, close to 10 o'clock ideally as possible, which then reduces the tracking error that could happen. If you were to put that trade on at midday, that's supposed to signal at 10 p.m. at night, you could have an opportunity that is a price wildly different than it might be at 10 p.m., or even a trade that isn't a trade by the time it gets to 10 p.m. because candlesticks are still moving, which means the indicator's still moving, which means trading opportunities are still being set and still being plotted. Okay. In terms of entering trades late, and again, this is all about tracking error against your strategy. In terms of entering trades late, this is very normal as well. So if you say to yourself, oh, well, I can't be there at 2 o'clock this afternoon because I've got a meeting or whatever, but I'll look at it at 3 o'clock. We are predisposed to enter trades that are going the wrong way. So if you look at an entry at say 100 pence, for example, that's when the trade was triggered at say 2 o'clock this afternoon. If you then look at it at say 4 o'clock, 5 o'clock, 6 o'clock this afternoon, let's say the target is 120, and let's say the stop loss is at 80. Okay, and let's say that so that's your take profit level. That's your stop loss level. So you wanted to buy it at 100 pence. That's when the trade was triggered at 100 pence per share or whatever it is. If you looked at this and the price was now trading at 110, or you looked at this and the price was trading at 90, what would you be more likely to enter? So would it be A or B? So what I'm saying is the trade was triggered at 100 pence and you got a 120 target and an 80 stop loss for the price there. But because you're looking at the charts late because you're in a meeting, whatever, you look at it and the price is at 110, or you look at it at a price of 90. Which one are you more likely to enter? Would you more likely to buy at a higher price at A, or would you more likely to buy at a lower price at B? What do you think it might be? Let me know in the questions box. That'd be kind of useful. Thanks. Okay, what do we got coming in? We've got a couple of A's, a few B's, mostly B's. Let me know, guys. Try and get involved as much as you can in this. It really does help, when it's a live session, really like this. Okay, so we're mostly getting Bs coming in. And what that is where people are sort of looking at thinking, that's cheaper than it was. Okay, so that's cheaper than it was. I was supposed to have bought it at 100, but actually it's 90 now. That's even better. Great. Most people would be more inclined to buy at B. You wouldn't trade Malcolm. That's probably the right play. If it's at 110, people generally, the psychology with most people would be, ooh, that's already, I've got to pay a lot more for that, and why would I pay 110 when I could have paid 100? a while ago, I'm probably less likely to take it. What's interesting about this scenario is that actually the trade is quite different. So let's just think about a horse race that's in the running. You've got the horse race before it starts, and then you've got a horse race that's in the running. It's already started. It's halfway through the race. Okay. Do you think what's more likely to win? Is it the horse that's in first place, or is it the horse that's in last place? Which is more likely to win that race? You see, if you think about it that way, A is the horse that's started its race and it's now in first place. It's doing what you wanted it to do. It's already moving in the right direction. Horse B, on the other hand, has kind of stumbled out of the gate. It's realized actually it's only got 3 legs and could probably do with 4 like all the other horses. It's going the wrong way. It showed good signs beforehand. Maybe it hit its missing leg. I don't know. So I don't know where I'm going with this analogy. But the point is, it's not doing very well in this race. And therefore, if it's already in last place, i.e. already going the wrong way, it's more likely to be a loss-making trade, isn't it? And yet, ironically, we as humans, individuals, are predisposed more to back this than we are this. And the reason for that is simply because it seems to be better value. But actually, B is the horse with 3 legs that's at the back of the field. Is it likely to win this race? No, not really. It's already going backwards. Okay, it could do, but its likelihood is less. And yet we're more likely to want to back it. It's curious, isn't it? I actually think that the way in which people approach trading is very, very different to the way in which they might bet on sports. And actually, if you applied your sports betting mentality to financials and trading, you'd probably do people would probably do a whole lot better, because it just makes a little bit more sense. It just seems everyone just thinks about things differently when it comes to the financial markets. It's actually quite a curious thing. But this is the thing with it, that, if you think about 4 potential outcomes, the trade could go up, the trade could go straight down, the trade will go down a little bit and then go up, and the trade will go up a little bit and then go down. In order for it to get to 80 pence, it's got to get to 90 pence first. So it's got to be, that there are certain trades that go straight to target. If this trade here, trade B, has a pullback, it's certainly not going to be one of those trades that went on straight to target. So naturally, out of 100 trades that type of setup identifies, some of them are going to go straight to target, but that's not one of these, which means it's more likely to be a loss-making trade, a loss-making outcome. Okay, the reward to risk might be a little bit improved by this point, and they may offset that somewhat. But the point is, it's not quite the same trade anymore. And actually, like I said, as individuals, as emotional traders as we often are, we're predisposed to look at a cheaper price and think that represents better value, thinking that it's still the same scenario. It actually really isn't. So there we are. Hopefully that makes a little bit of sense. If you think about it like a horse race, you think about it like a football team that's already winning its match. Is it still likely to win by the end of it if it's already 2-0 up? Yeah, probably, yeah. So it's just a little bit different. Is it more likely to win a match when it's 2-0 down, or is the likelihood of it winning a match at 2-0 down the same as it was when it was 0-0 at kickoff? No, it's not the same situation anymore. And by entering trades late after the event, we're more likely to back an inferior position. So this all lends itself to trading a time frame that better suits us. And you really want to be trading a time frame that you can monitor. The shorter the time frame, the more time you need to spend looking at the charts. That feels kind of obvious, really. So when I look at time frames, I kind of think people generally fall into one of 3 areas, or 4 areas, which is they probably don't have enough time to trade at all, I guess. But typically the best time frames that I think are right for people are where we factor that lifestyle in and we trade accordingly. So for example, for the vast majority of traders, and certainly beginner traders before they choose to allocate more time to this, the daily chart is a great great place. I continue to trade mostly the daily time frame because it suits me the most anyway, and my personality and the way I want to do things. But the daily chart's good. Typically for our strategies, 20-30 minutes a day. Nice and convenient, straightforward, and so on in the evening. A 4-hour chart is better suited to, or has the opportunity for, people who are perhaps computer based, self-employed, retired. They've got a bit of time to look more actively than someone who works full time, but they don't really want to spend all day looking at the markets either. They want to be able to, I don't know, have a couple of meetings in between, or maybe go and, I don't know, mow the lawn or something, whatever. Go and have a quick round of golf. These things, are perfectly reasonable, but doesn't mean you can't trade a little bit more actively. The 4 hour chart effectively means that you have an opportunity every 4 hours, whereas a daily chart, you effectively have an opportunity every day, effectively at the end of each day, each candlestick, and each candlestick on a 4 hour chart is every 4 hours. So you potentially have 6 action points a day, whereas on the daily chart, you have 1 action point a day. That's basically the way it works. On a 1 hour chart, you have one every hour. You can't do a lot in between those hourly points. So it actually, in my opinion, makes it quite a restricting time frame. It's almost like you're chained to your desk because you sort of fear of going away, because if you go away from your desk to do something else, you're not going to be back at your desk quickly enough to look at the next set of opportunities. I also think that indicators don't really work so well over, on the 60-minute chart, because I feel they're a little bit confused by overnight price action. But in any case, I feel that's a time frame that's probably quite negative and difficult to follow. Statistically, it might be okay, but actually in terms of implementation, the difference between what works in theory and what works in practice, I would suggest a 60-minute chart is really hard to do in practice, because you're always going to be distracted by something, right? And that's similarly for the 15-minute chart. You need like 7 or 8 hours to trade the 15-minute chart effectively, whereas the 2-minute chart, you could trade a block of 2 hours, which most people can achieve, particularly if they want to, and you can trade on a 2-minute chart quite easily. So that makes it quite good as well. So you think about the amount of time that is required. 20 minutes on the daily chart, probably 20-30 minutes a day. 4 hour chart, 20 minutes 3 or 4 times a day, and the 2-minute chart a couple of hours a day. These are bite-sized actionable amounts of time that most people could commit to, whereas a 15-minute and a 60-minute really isn't. So why am I talking about all this when I'm supposed to be talking about the 4 hour chart? It's important to understand why. I could just sit there and say, oh, we trade the 4 hour chart, brilliant, let's move on. But actually, I think it's better to develop an understanding of things, really. Because otherwise, it's good to understand why things are done in a particular way. Otherwise, you might go off and develop bad habits yourself. Because, I can tell you why to do something, but you should also know why not to do something, I think. So what is it then? So the benefits of the 4 hour chart is, for me, it suits a lot more people's lifestyles. So, like I said, computer based and so on, it's pretty good. You don't need to trade every time slot. So it's all right if you miss a few trades, because there's plenty of opportunities. So, if you can't do 2 o'clock in the morning, which you shouldn't be anyway, that's okay. If you can't do it 10 o'clock in the morning for whatever reason, that's when there's some opportunities. That's okay too, because there'll be plenty of opportunities coming up at 2 p.m., 6 p.m., 10 p.m. and so on that we can get our teeth into. Because of the range of movement, that gives us a good range of markets that we can trade as well. See, really the way this works is the shorter the time frame you look at, the more careful you need to be about the markets you're trading, the more sensitive you are to dealing costs, and the more you want markets that are more volatile, the more speed behind them. So when you're trading a 4 hour chart, there's still decent movement, which means you can absorb quite a bit of cost into decent movement. And because of that, you can trade a broader range of markets. So Forex, indices and commodities typically are pretty good across probably 30, 40 different markets there. Plenty of choice. It's active, not too active. Good movement relative to the spreads is what I'm talking about there, which is why you can look at lots of different markets. And low trade duration as well. Typically trading on a 4 hour chart, we might be in a trade for a day to 3 days. So actually the cost of carry from a spread bet or a CFD is actually relatively low over that period too. Okay. Quick yes or no. Is this all making sense so far? Are you still with me? Yeah? Let me know. That'd be great. Okay, so that's a little bit about the 4 hour chart. Malcolm asked earlier about time slots. What do you got? A quick question from Malcolm, actually. I've used the 4 hour as a possible indicator for the daily, but got out of habit as it's too much information, possibly your view. So Malcolm, could you use the 4 hour chart to help you with the daily chart? Yes, you can do. Do you need to? No. Could it help you to get an extra sort of 10%, 15% improvement in your results? I think it probably could, because it can give you a little bit of that momentum and so on. You'd be like, well, I like this trade, but look, the market started to going the other way on the daily chart. Why don't I wait for the 4-hour chart to move back in line again, type of thing? It can allow you to get a sort of a better bit of momentum behind the entry sometimes. But is it the be all or the end all? The be all and end all? No, not really. It's a little bit like this. It's a bit like, think about a golfer who wants to go from being, a good, solid enough golfer, maybe off 10 handicap or something like that. How can that golfer, good standard, in trading terms, you're making a nice profit. How can you then get to a point where you're a low single figure golfer? Those are the sort of things that you would then incorporate. Your in terms of golf, your risk management, your trade management, your golf shot management, what you might hit off the tee, the way in which you play, and so on. Those are the sort of the details we get into it, where you become a more effective trader, but that doesn't necessarily mean you have to. Okay, Malcolm. So think of it like that. I guess, is the additional time worth the reward? That's probably up to you to say, I would think, and whether you have that time. Anyway, let's think about times of the day. So our charts, when we look at 4-hour charts, our charts here at Trentinel, we look at it starting effectively at sort of 10 p.m. Friday, 10 p.m. Sunday, effectively the same time in a way. That's when it all starts. So really what we have from 10 p.m. Sunday, we then have a 2 a.m. candlestick, 6 p.m., 10 a.m., 2 p.m., 6 p.m., 10 p.m. These are UK times. It's effectively the end of day will be at 10 p.m. That's 5 p.m. Eastern time. So effectively, these are the time points where a candlestick closes. That is when indicators are set and locked. So unless you're trading like a breakout type strategy, if you're looking at indicators or candlestick patterns and chart patterns and things, typically you're looking at candlestick close. Okay, so this is when the candlesticks will close, notwithstanding daylight savings when we're at a sync or whatever. But effectively, those are the times for probably 50 weeks of the year. There are times of the day and days of the week that are different. And what I've done is I've highlighted those there. So the yellow blocks are times of the day and week where it's probably less effective to trade. And let's go through that. So 2 o'clock, I've kind of blanked that out as a sort of a difficult time to be trading the 4-hour chart. Now, why might that be? So when you're analyzing data, the more data you're analyzing, the better your results and findings are likely to be. The problem with 2 o'clock in the morning is when you're looking to make decisions that are based on indicators or candlestick movement that's happening at 2 o'clock in the morning, is like, well, who's trading at 2 o'clock in the morning? It's like the volume behind that move is wildly different, so very low typically. So in which case, should we be making decisions in the same way at 2 o'clock in the morning than we should be for the rest of the day? No, not really. Very often what you'll find is that 2 o'clock in the morning you get a lot of false signals where the market kind of limps into a trade, and then as soon as volume picks up again as you get through to late morning, that's when normal sort of service resumes. So you end up with a lot of fake sort of dodgy moves which are not really based on much follow through, if you see what I mean. What you want with technical analysis to be trading sort of the heat of the day, where there's good action, good participation, lots of traders out there, whether it's banks, hedge funds, individuals, and so on, making the market, creating volatility, creating speed of movement. That happens a lot less at 2 o'clock in the morning, which is why the moves can be often smaller, but sometimes, bit dodgy in its rotations. Therefore, I wouldn't be interested in doing it. And it's not because, I want to stay in bed. That's like a convenient kind of thing. It's actually just simply the case that statistically, it doesn't actually make any sense to be trading really at that time. So that then brings us into 6 a.m. on a Monday and then Friday afternoons. Why would Friday afternoons be a time to perhaps be mindful of a 4-hour chart trade? Let's think about the behavior of a trader and investor. If you've had a market that's been going up all week and then you've got a weekend coming up, what's likely to happen. So anyone who's long that market, they're coming into Friday, they're thinking, okay, well, I've got a nice bit of position, I've got a position on here, got a nice bit of profit on. I've got 2 days now, maybe 3 days if it's a bank holiday, where I can't manage my risk. Okay, so what am I going to look to do? I'm probably going to look to take my profits or reduce my exposure. So a lot of big pension funds and hedge funds, as you come into the weekend, are going to look to reduce their risk, which means reducing the number of positions or the size of those positions. So if you've had a market that's had a big move in the week in particular, you can see that market start to reverse a little bit into the weekend. So it's a little bit big move up, little small pullback, and that could end up identifying a bit of a short trade for us depending on the type of setup we're looking for. But that's nothing more than profit taking. It's almost artificial in a way. It's nothing more than profit taking into the weekend on a Friday afternoon just before, but actually as soon as we get back to Monday again, well, think of it this way. Unless something changes, you would expect the market to carry on, broadly speaking, in the same direction that it was going. So if nothing really came out over the weekend and everything else was broadly the same, you'd probably expect the market to carry on a Monday back the way it was in the first instance. The problem is if you're sitting there having taken a short trade on a Friday afternoon, thinking, oh, that's a new trend forming. It isn't a new trend forming, it's profit taking. Okay, it might be a new trend, but on balance, the risk is it's nothing more than profit taking. It could well be, or more likely to be, nothing more than a shallow pullback before the market, all other things being equal, could perhaps resume its uptrend the following week. So we have to be mindful of that. And in our experience, you get more likely to get false signals with any strategy, I think, probably is at 2 o'clock in the morning over low data, and a Friday afternoon where it's not really new trends, it's not new activity, it's probably more down to profit taking. Okay. And then, why Monday morning? It's a little bit of a hangover from that. So, when you're trading, depending on your indicators and so on, sometimes it takes a little bit of a while to digest Monday morning's data. Sometimes the indicators, they're lagging, right? So generally indicators are lagging. That's not a problem. A lot of people think, oh God, they're lagging. Ugh. It's not a problem. It's absolutely fine. But it can mean sometimes that hangover from Friday afternoon finds its way into Monday morning. Why don't we wait a little bit? Why don't we wait for Monday morning's economic data to kick in? Why don't we wait for the UK stock market, the European stock markets to start to kick in, and then we'll start trading it from sort of mid-morning on a Monday. You'll find that these yellow blocks are where there is a higher likelihood of false signals than there are otherwise. And like I said, that's not just a trend signal thing. That's something we've identified from analyzing thousands of trades and so on, and market movement over 20 years near enough. But it's just normal. It is what it is. And that'll be the case whether it's a trend signal strategy or any other strategy, to be honest. So again, hopefully that makes sense. What does that mean for a Friday? Does that mean that you should go to the pub? Yeah, maybe. Does it mean that you should just lift a few profits? Yeah, possibly. In a way, I've always been an advocate of, keeping the risk low. So if you've got quite a few positions on, taking a few profits off as you come into the weekend, it's just going to reduce the volatility you might experience in your trading account. So the smoother your account performance can be, the better and easier the psychology is anyway. Okay, so hopefully, again, that's kind of helpful. So for me, in terms of the way in which I trade this, and again, this can give you a little bit of guidance on what we look at here. I generally look at currencies for this. I quite like currency trading because nice low costs, good leverage available, but also you can still trade indices and commodities, you understand, but FX is useful because actually a lot of the markets move in a similar speed. Indices are generally much faster in points terms, and so is gold and so is oil than the likes of the majority of currencies, notwithstanding what's going on with the pound at the moment, which is obviously sort of hair raising. But ordinarily, they move in a relatively similar speed, apart from perhaps sterling New Zealand, maybe, and sterling Aussie. Trade durations, a few days typically. I like about a 4-hour chart. It's relatively tight stops, tighter than a daily chart, for example, tighter than a weekly chart, that sort of thing. I like looking at momentum. The way in which the type of rotations we look for is similar. The main difference that we have when we trade on the 4-hour chart, and I think this is an important point to make for anybody who's looking to trade the 4-hour chart, whether it's using trend signal indicators and strategies or otherwise, is that there is something that I think you need to do, which is that when you look at a 24-hour market, it can be distorted by overnight price action. So what I mean by that is if you're trading a daily chart, every day is basically the same, where it includes the heat of the day and it includes overnight price movement as well. So with daily candlesticks, you can't really adjust for overnight price movement because it is every bar has an overnight price movement. If you're trading on a 2-minute chart or a 50 or 5-minute chart, for example, you'll probably trade at, I don't know, 8, 9 o'clock in the morning, maybe in the evening, maybe 2, 3, 4 o'clock. Those times are not distorted by overnight price action because you're trading over a short-term period where the indicators have got plenty of time to catch up and do really what they need to do. So that can be absolutely fine as well. The problem that you often find with a 4-hour chart is that if you think about a lot of the movement that we experience in the markets is going to come during stock market opens, stock market closes, and any announcements that take place. Those announcements might well be economic announcements, it could be corporate results. All of these things will have an impact to varying degree. It could be an interest rate change, it could be a budget change, whatever it is. Those things are typically happening between probably 7 or 8 o'clock in the morning UK time, right through to 9, 10 o'clock PM UK time. So there's, what is that, a 14-hour window maybe. That's where a lot of the movement is really taking place. Outside of that, there is some movement and some economic data released in the Far East and so on, but it isn't typically as prominent or as high impact as it is over in the sort of Europe and in America, notwithstanding what happened with the Bank of Japan over the last few days. But the point really is that ordinarily there is sort of lower movement, lower impact. And what that means is you can often get this kind of big movement and then sideways, big movement, sideways overnight, big movement, sideways overnight, down, sideways, down, sideways, down, sideways. And this is important because if you're looking at indicators, the problem you're going to have if you don't acknowledge this, and it's not difficult to do, by the way. If you don't acknowledge this, if you're looking at indicators like MA crossovers, stuff like that, you might find that you get some dodgy signals take place overnight. Again, that's an issue that we've talked about earlier. It's like not trading overnight because that might flip you into a dodgy trade, because that flattening out for a few bars, 2 or 3 bars, or 2 bars probably, is going to be a bit weird, and then down it goes and so on. This is your overnight kind of movement where it's more likely to be flat. The problem with that is that the indicators can get a little bit confused by that. So what was something going up is like, whoa, it's going to go down, and then it's going back up again. In my experience, and what we do is we slow the settings down for our indicators. So actually trading on the 4-hour chart, we have historically found much better results by just slowing down. So if you're looking, as an example, we don't use moving averages, but instead of using at a 20 or something like that, maybe it's better to use a 25 or a 30 or whatever. I don't know. But the point is, by desensitizing your indicators a little bit, what it does is it removes the noise that can take place from overnight price movement. And I'm getting kind of technical here, but this is the sort of degree of information and study that we do. Remember, we've been doing this for 20 odd years, teaching people how to trade. So we know the issues, we know the pitfalls, we know exactly what happens to the market, and we also know how to deal with it as well. So I could sit there and say, oh, you always use the same settings, but that would be wrong, because actually the markets behave differently. So in my experience, you need to sort of almost desensitize the overnight movement or the impact of overnight flattening of prices a little bit, just by adjusting the settings that you use on your indicators. Now, we do all that automatically on the system that we provide our traders with, you understand, but again, it's just to reduce the overnight noise. Okay, actually what you want is an indicator that kind of carries on with it and doesn't get worried about it too much. Again, hopefully that makes sense. I appreciate I'm probably getting mega technical here, and I don't always go into this sort of degree of detail, but it, it's important to understand, systems really or strategies need to factor these sorts of things in. The problem for a lot of people is that they probably don't, or probably because you haven't thought about it, or it just hasn't been done, or I don't know what really. But it doesn't mean it isn't important. Again, hopefully you're all still with me, still making sense. Hopefully, guys, these are the sort of things that we battle with as strategy designers and creators and system developers, to make sure that we look at the way in which these markets actually move. And this is not about looking at something over a 1 week or 2 or 3 weeks. So, well, actually that's happened over the last couple of weeks, that's kind of interesting. This sort of data has to be analyzed over 10-20 years, really. Do you have an update on the 4-hour charts showing the best times, albeit historic? No, I don't actually, Malcolm. At this point, this is something that we've seen from our analysis previously. We haven't necessarily repeated that analysis. Really, we sort of allocated our time to something else rather than reproving, I guess, something that's already there. But I'm fairly convinced it's still the same, really. Okay. So let's have a little look. We're not going to spend too long on charts because, sometimes I like to sort of get into the theory of it really. When I'm trading the 4-hour charts, principally what I'm looking for is the same as what I might look for on a daily chart. The difference with our system really, we don't have snipers on our 4-hour charts, but then that's okay because largely trading the 4-hour chart is sort of phase 2 in the development of a trend signal trader. So what we're going to do is we're generally looking for longer term trends. I'm going to bring a chart up here and we can have a little look at it. This is a chart for Aussie dollar. Why don't I have a look at pound dollar just for a bit of a laugh? I say laugh, it's not funny at all, is it? Why did I say that? But it gives you an understanding of, I guess, what's sort of happening here. Anyone who's following trend signal for a little while will know that what we do is we build strategies, and have done since 2003, that are all about looking at trends. The markets move in certain ways, and what we're looking for is to establish ultimately which way that market is most likely to move. So, for example, that was a short trade there. It was at 6 a.m. on the 21st of September, and it was a nice short trade. What helped us to identify this as a short trade? Well, let's go through it. Basically, what we look at, and I talked about the slowing down of our settings. I mean, one of these is by using what we call the vector average line, which is this green and red line. This helps us to identify a change in direction in a market. So for us, I'm not interested in trying to guess highs and lows. Looking at support and resistance is very difficult to do. Most people don't have the time for this. And actually, what we exist for, at least our raison d'etre, if you like, is to provide a usable solution for home traders. I could teach people support and resistance, but most people wouldn't get it, and you'd have to spend hours and hours and hours and hours and hours and hours and hours to get it. And even then, it's still very difficult. It's not a criticism of anybody. It's just that it's just not practical. You have to spend so long trying to work it out, and even then, I still think there's an awful lot of luck involved in support and resistance and getting the highs and lows right. Fine for people who really want to live and breathe trading, but most of us don't. I certainly don't. I like it, don't get me wrong. I like the benefits that come with it, but I don't necessarily want to sit there and spend 6 or 7 hours of my life analyzing a chart. So what we're interested in about is finding a sort of a workable solution for individuals to trade. That's kind of perhaps a better way of putting it. So what we look for is the direction of price. Direction of price in this case is demonstrated by the color of this line, whether this line is red or green. So when that line changes color, it effectively tells us about a short-term change in direction of that price. Okay, so if it moves from green to red, for example, that is a turn down in the direction of price. In other words, prices were rising, but now prices on balance seem to be falling. And similarly, you see that scenario A, and then you see scenario B, scenario A being a turn up, a potential up move in price, and B, a potential down move in price. What we have done and what we do is, in order to build strategies, we have to look at the context. So we analyze what's happening around those turning points. So at any given point, we can establish what's happening with momentum, longer term trends, intermediate trends, supporting candlestick patterns, chart patterns, that sort of thing. All of these things should actually be considered when you look at a particular opportunity. And what our system does is whenever those elements are on the chart, are present, shall we say, then you get certain annotations that pop up on the chart as well, just to help make it a little bit more straightforward. So as an example, as this line changes from red to green to red here, what can we also see that's happening? Well, this line here, this orange line, is the midline, if you like, for the 4-hour chart. This is effectively telling us that the 4-hour chart is falling, okay, on a broader basis. So the red line is on a short-term basis, but the orange line on a broader basis. So that's a tick. That effectively means that this market is falling, and we've got a resumption of that fall. That's good. What we can also see with the DT here and the arrow here is that the daily trend is also falling. So without having to look at a higher time frame, our system knows that the daily trend is also falling. Why is that useful? Well, effectively, what we'd rather be doing is, if you think about getting onto a conveyor belt at an airport, you'd rather get on the conveyor belt that's moving in your direction. It's going to be far easier that way than it is going against the direction, isn't it? So what we're looking for is things that can help demonstrate whether we're moving downstream or whether we're going to have to fight our way back upstream, i.e. against the trend. So the more that we can have tell us something that this market is more likely to do this, the more confident we can be with that trade. Okay, at the moment, the intermediate trend, the 4-hour chart trend is falling, the orange line. The daily trend is falling, the weekly trend is falling here. Again, without having to look at the higher time frames, we sort of conveniently put that up there to make it simple at the point of use. And then also the candlestick patterns and chart patterns are in place as well. So in layman's terms, what you're seeing is a high, you're seeing a lower high, you're seeing a lower high, you're seeing a lower high. Do you know what I mean? You're seeing a market that is just ratcheting its way down. So effectively, what you're saying is this is the river is flowing in a downward direction. I just need to jump on it. We're going to bump into a few rocks here, might slow the pace down, and then all of a sudden we're going to move back over those rocks, slide back downhill to then take the market even further down. The system is all about identifying those different elements that we can then look to trade them with confidence. You can also see momentum down here as well. So the momentum is still at this point down, albeit in an oversold position. So it's looking at that framework. Effectively, what you've got there is 1, 2, 3, 4, 5. You've got 5 elements there supporting this downward direction. So 5 ticks. That's effectively saying, look, this market's on balance is doing this. It is more likely to fall, and it is therefore a higher probability short trade. That's effectively what our system does. Now, the fact that that was first thing in the morning on the 21st of September, that's pretty cool too. It's a good time at which to trade, and it ended up being a really nice short trade. We can see similarly, by the way, a couple of things here, which is useful to look at this turn up. Was this a good looking trade? Well, there's a couple of things about it here that we can see straight away. If you look at the time of the trades, let me just put my cursor and look at the words down here if you can see them, but also you can look at the time here as well. Okay, so if I put my cursor over this candlestick, what does it say on the top of the chart there? What time is that? It's 02:00, right? That's 2 o'clock in the morning. Remember the slide earlier for times at which to trade? That's probably a bit of a ropey time to trade. There's probably not going to be a lot of oomph behind it because this turn up has been determined from overnight price action, which is probably based on not that much oomph. So we probably wouldn't be too interested in it in any way. But let's assume that we were. What is the context of this? What's happening here that might determine whether I want to take a trade or not? Well, the movement up, well, we don't see a CP. There's no CP written there, which means this is not supported by an uptrend on a positive chart pattern. Okay, so the chart patterns at the moment are down, so we're going against that. That's why it's not written there. You don't see the WT written there, which means that this move up is against the weekly trend direction. That's why it's not there. You don't see daily trend there either, which means we're moving against the daily chart direction. You still see the orange line there as well, which means that the intermediate direction of the 4-hour chart is also down, so the intermediate trend is against us too. Okay, you do have momentum, that's positive, and also it's from an overbought position, but effectively, you put an M there for momentum, that's positive. You got one thing there. So all you've got going for this is that it is an oversold market in a whopping great downtrend. It might go up, but it's probably not going to. The consistency within which moves like this generate profitable trades is not good enough, so therefore we would not be interested. The more ticks that we can put in our favor, the better, and the more confident we can be about the opportunity. That's it in a broad nutshell, okay? And that's how we're looking to identify trades. Now, remember, if you're trading on a daily chart, that's a little bit different because on daily charts, we have those sniper discs and so on to help us to identify, our favorite trades. So you can see there, the right types of parameters are basically there as well. The difference is that you've got one of these discs there on the daily chart. On the 4-hour chart, it's the sort of phase 2 in the development of people, of our customers, our members using this system. So, we just demonstrate the opportunity slightly differently so you can really get into it a little bit more. Okay. But that's basically it. It's not really that complicated, really. It's just a question of building a picture. So the first part of the picture is the fundamentals, which I shared with you at the start. The second part is then the application and being able to do that from a technical perspective. The good news is that the system spots that really conveniently. And in fact, if I go through, some people often asking what's behind the higher time frames? How do we know whether the higher time frame's moving the right way or not? Well, if I go to the 4-hour chart and have a look at pound dollar again, I look at the higher time frames here, it's all there. Okay, what you've effectively got there with that sell trade, you look at that, I want you to look at, my cursor is going to show on here and it's going to show on here as well. Look at the color of the line, this line here. This line here is the same as this red line here. That's still the vector average. The question is, what is the color, broadly speaking, what is the color of that line on my daily chart? What is the color of that line on the weekly chart? Well, let's have a look, shall we? You see that? You see the vertical line, the horizontal line there? So it's red on the bottom left chart and it's red on the bottom right chart, which is effectively telling us that we have a couple of powerful forces pushing the market to drive lower. Remember what I said earlier. The whole basis of trends really is that the market is more likely to carry on in its existing trend unless new information comes to light. Okay? Trend is your friend. There's an expression like that for a reason, that the market is more likely to carry on its existing trend than it is likely to reverse unless something else comes into the picture. So the more you can capture the direction of the trend, the more successful as a trader, or the smoother a journey it should be. So what we're looking for here is a confluence of indicators, a confluence of time frames to help us to establish an entry point or a resumption of a move back in line with those directions. And that's basically it. Okay. I don't think I'm going to take any more time from you guys. I think you've given me enough of your Tuesday lunchtime, but hopefully that's really helpful actually, and gives you a bit of a guidance into what we do and potentially how we could look to help you with this. Guys, if you're interested in what we do, then here's the details there. If you'd like to have a call from one of the team about the trend signal strategies, the courses we provide, then just pop your details in. Just type phone me or something like that into the questions box, and I'll make sure one of the team gives you a call. We can guide you through the different tools that we have here and how we might be able to help your confidence. Just type phone me in there. Alternatively, you've got the phone number and email address on the web on that slide there that's on show as well. And guys, look, hopefully you found it useful today. And some feedback as ever will be good. So if you enjoyed today's session, let me know. If there's any other topics you'd be interested to learn about, but maybe I haven't covered yet, please type those into the questions box as well, and we can look to do that for a future Tuesday lunchtime session. Otherwise, everybody, all the best. Thanks very much for attending, and I wish you every good fortune with your trading. Bye bye for now.